Hey everyone, and welcome back to the show. Today we have a very special guest, a passive investor himself, Johannes. Johannes, welcome to the show.
Thank you. Thanks for having me.
Of course. So everyone, Johannes is a professor of energy resources and environment at Johns Hopkins University, and he's a new real estate investor. Now, Johannes and I met at a conference earlier this year, and I think that his experience is going to be very valuable for folks who are new to passive investing to learn from a fellow relatively new passive investor. So Johannes, why don't you go ahead and tell us what drew you, who you are, what you do at Johns Hopkins, and then what drew you into the real estate space.
Absolutely. So I'm a professor at the School of Advanced International Studies, which is our policy school here in Washington, D.C. I live in Arlington, Virginia, and I've been here for the past 4 years, teaching in the fields of energy and environmental policy. And I started investing in real estate about 2 years ago, mostly because I was looking for ways to diversify. The equities like S&P 500 had been going up and up and up every year, and I wasn't sure if that's going to continue forever. And at the same time, I also thought that it might be possible to get better returns from real estate. So I thought I'd give it a try, and so far it's been a pretty good experience. So I've been investing more and more.
Awesome. So, that's an interesting point that you brought up about the S&P 500 going up and up, and you're not sure that that's going to continue. I tend to think that when the stock market is going up, people are excited to stay in the stock market. So what is it that gives you this sort of pause?
Okay, so it's really basic mathematics. Stock values go up for two reasons. One is that companies produce more money, and the second is that they produce dividends and you reinvest them, right? The more people pay for a stock, the less dividend they get compared to that price. So that is going down and down. Every year, your dividends compared to the value of your portfolio are going down. And so that puts even more pressure on the returns and the profits of the companies, and they are not increasing, they are the same. So as a result, all of the increase going forward, most of it, not all of it, but most of it will be speculative. And I don't want to put all of my money into what's basically becoming a speculative asset today.
I see. So that's, I think you explained that in a very clear way. Is that what people call the price to earnings ratio?
Yes, exactly. So the price to earnings ratio today is extremely high. And many people, initially, I also thought, so what? It can go up for different reasons. But what people don't realize that every time the PE ratio goes up, it becomes more difficult for the PE ratio to continue going up. And as a result, at some point, things are not going to be great in the stock market.
Awesome. Well, thanks for breaking that down. It's an important concept, I think, for people to wrap their minds around, because I think a lot of people aren't so, we generally know, oh, the stock market's been really good for the last, since 2012 or whatever. And there's an expectation that that might continue, but obviously we know that the market goes in cycles. And so it's just, thank you for explaining it in terms of that mathematical way. So what is it about real estate that appeals to you in contrast to the stock market?
Yeah, there's a few things. I think on a more serious note, one of them is that it seems to me that especially multifamily real estate is fairly resistant to recessions. We didn't really see rent decreases across the country, for example, during COVID-19, even though where I live, we took a nosedive 20% here in Arlington, but that's because we are a crazy expensive market. But overall, people have to live somewhere, right? So until we come up with a completely different way of living, there's going to be some demand for these assets. That's one reason. And the other reason is that, at least for me, I find real estate a lot easier to understand than other companies, right? So if you give me a spreadsheet that tells me what the deal looks like, I can figure out in 45 minutes what's going on here, right? But if you ask me what should be the real value of Google or Apple or some startup 10 years from now, I really have no idea. I don't know if I'm buying the right thing. So I find real estate appealing because it's kind of recession resistant, and it's something that I can understand, at least to some extent.
For sure. That makes a lot of sense. It seems like that makes common sense to me as someone who's in real estate a lot. It's like, well, we value the property based on the NOI and whatever the cap rate, whatever cap rate it's currently trading at. But I never really, since I don't invest in stocks, I don't actually think about, well, how do you actually value a stock? So, as a passive investor, since this is somewhat of a, will you go over how it is that you will examine the value of a piece of property that you're looking at?
So first of all, I'm a new investor and I'm entirely passive, so I would certainly not take my analysis too seriously, right? It's just what I try to do. So what I would do first is I would take a look at the sponsor. I think the most important thing for me is that it's somebody who has a track record and a good idea. So business proposal, kind of idea why it would bring value. So that's most important, is that it is really the sponsor and not the deal itself. The second thing I would look at is the market, though I have to say I'm not very good at that. So it's hard for me to figure out why Phoenix is hot right now and some other market isn't. But I try to get a sense of, at least, is it a growing market? Like I wouldn't want to invest in a place where population is declining, right? Because that will automatically bring the returns down. And then I would look at some of the basics, like, okay, how much leverage do you have? Like, how much debt do you take for this? Because that makes it more risky, right? If you have a lot of debt, then it's more risky. I would look at what kind of renovations. Are you doing just a little bit of work to make it work, or is it you're building from the ground up, right? So I would try to understand how much work it takes. And then the assumptions, right? Do you assume that the local market grows like 2% a year, 3% a year, 5% a year, and is that reasonable? And then I would definitely look at at this cap rate, right? So what is your assumption about how much do you get out of it when you sell it? Because I've noticed that if you move that number just a little bit, you can make the returns like double or go down 50% very easily. And then final thing, I do pay attention to the waterfall. So how much of the deal goes to me as a passive investor as opposed to the sponsor. So I'm looking for something where the fees are reasonable, and there's good return for me, some preferred return, some kind of nice split, but at the same time, some incentive for the sponsor to perform, right? So that they actually work hard to make it work. So those are the things I would look at. But again, I really don't buy my own analysis, that much. I just do it to try to understand what's going on, and then I ask the sponsor any questions like, why do you take so much debt, or so on.
For sure. Well, as a passive investor, you've got to somehow find what your balance is between doing your own analysis and because it's not what you do full time. You
right.
have a full-time job that you're doing, and so you're not going to be. You may not be the full expert on it, but understanding enough of the basics to be able to not walk in kind of blind. So, what got you thinking about real estate in the first place? Just backing up a little bit.
It was really just looking at the stock market. I was, starting to make some money as I advance in my career, and I need to do something with that money. I'm not a big spender, so I save most of my money. And so I had to do something, and I was getting a bit worried because like I said, the returns in the stock market were historically extremely high in the past 10 years compared to what they used to be. So I thought this probably means that at some point there's going to be a decade when they're not going to be very good. And so I actually started trying to actively invest. So I have one rental here. I'm not loving that, and I don't think I'll be doing that for much longer. I like passive investing a lot more, but that's how I got started.
For sure. I mean, and I think that's really important to understand what it's like to be an active investor and to try both, right? Because, one might fit one person better than the other, or maybe some kind of combination. And so I'm really glad that you tried it. What was it that you didn't love about it?
Well, first of all, I had to find a tenant here in Arlington in a kind of extreme class A market during COVID-19. So that was not fun. I did find a good tenant and things have been okay since, but doing 15 showings and not getting anything, at some point you start feeling a bit down about it. That was one. And then the other reason was that I do think the best returns in real estate come from actual value add. And I'm pretty hopeless with that stuff, right? So I really wouldn't know how to add value to a property. I was just like everybody else. I didn't know much about real estate, so I thought you just buy something and wait, right? Which probably was a great move in 2010 in LA. But now that I've studied this a little more, it seems like a terrible move today. So I realized that it's better if I put my money with somebody who knows how to do that value add. And that will give me better returns, and I don't need to stay up worrying about tenants and granite countertops and all that.
Yeah, for sure. I mean, I think that's such a good point. Like, you're fully engaged in your career, and actually running a real estate, running rental real estate it's like another job, right? And you can definitely do it on the side. People do, but when you compare the actual returns, like I look at the return on equity. And so when you look at the return on your equity in a rental property versus the return of equity on a syndication, assuming that the syndication is turning out the way that you anticipate it, they're able to meet their projections. How would you compare the returns, like with your class A, for example?
I think the syndications should produce much better returns. So the way I would think about it is that if things go really well for me here, I might get the returns that I expect from syndications. But my class A condo here in Arlington is not going to produce, a home run. There's no way. Now, it is true that if I had bought in 2019 sort of accidentally a single family home here in Arlington, I would have already made a crazy amount of money on it. But that's just dumb luck, right? Because of the interest rate decrease with COVID-19. I think the single family prices here are up like 15% or something. And with 70% leverage, that's like a 45, that's a home run. But that would be just dumb luck, right? Not because nobody had any idea about this COVID-19 thing, right? When we were looking at these things.
Yeah, for sure. Yeah. I mean, I think that's a good point, is that when we're looking at value, I mean, of course, the market appreciation is always going to be a factor in how things turn out. But when we're looking at properties, we're looking at ways that what we do can actually drive the NOI, not just market appreciation. So if there is market appreciation, great. If there isn't, hopefully, and that's one of the reasons why we like to invest in growing markets, because that's a hedge against the market, taking a turn for the worse. But anyway, so we like to drive the appreciation so that we're more in control of it, right? And I think that's one difference between the stock market and real estate, is that you have some control over the outcome, whether it's control that you're actually doing, as with your class A, or whether you're putting your trust into somebody else, into like one relatively smaller entity rather than a large corporation. Plus there's the whims of the stock market, et cetera. So yeah. So would you say that, how many deals have you invested in, and what do you anticipate going for? Are you only doing multifamily? Can you tell us kind of like what you've done and what you're looking to do?
Sure. So I've invested in 2 funds with larger sponsors, and then I've directly invested in 4 different deals. And most of them are multifamily, but I also have 1 medical and 1 industrial facility that I've invested in. And this is for diversification reasons. My own plan is that I'm probably mostly going to invest with these large sponsors that have well-diversified funds to reduce the risk of losing capital, and to just make it more diversified. But I'm going to spend some time looking for great sponsors and make direct investments. And I'm probably going to add anywhere between 2 to 6 deals a year, depending on returns and other income from my job and my consulting business.
Okay, awesome. Yeah, I think that makes a lot of sense to, that's one of the benefits of certain funds, is that you can diversify across, and well, sometimes you can diversify. If you're investing just with one operator, then you're able to diversify across properties and geographies. And then there's other types of funds where you can invest in one fund and have diversification across asset classes and geographies and operators, which is like a whole nother level of diversification, which may or may not be suitable for every investor. So thank you for that. Now, I also wanted to get a sense of, I know that climate change is very important to your work, and that's a reason that you're interested in real estate. Can you speak to that a bit?
Absolutely. So I think climate change is going to be a really important factor moving forward in real estate. There's already been a number of studies that look at some of these markets that are facing sea level rise, for example, in southern Florida, and markets that are very sensitive to hurricanes or storms or heat waves. And it turns out that the property prices are not increasing in those markets as fast. And I think everybody who followed what happened in Texas earlier this year, you saw some very serious problems with many of the real estate assets in that area. You see very high insurance rates now. The insurance companies are really charging much higher rates now that they realized how common these problems have become. So I am of the mind that extreme weather is going to be a really important driver of real estate values moving forward. And I would not myself invest in a market that is very sensitive to climate change.
So that's an interesting question that you just posed, because what would you consider as to be markets or places in the United States that don't have some sort of extreme climate change risk? Because to me, I look at the climate change risk maps, and there's wildfire risk on the West Coast, and then into the Rockies, et cetera. And then of course there's the storms, and then there's earthquakes, and then there's hurricanes and sea level rise. So where do you have any thoughts on as a climate change?
You're right. So everybody has some climate change risk, but it does vary significantly depending on where you are. So for example, the Midwestern states are not that sensitive to climate change. Now, they have their own problems when it comes to population decline and all that. So difficult to invest in many of them in any case, but they might do better in the future just because of climate change, right? They're very favorable for any kind of business that, for example, depends on natural resources moving forward. Let me take one example, Florida, right? So Florida is a very important real estate market. Everybody loves doing deals in Florida, right? But even within Florida, there's huge differences. If somebody came to me with a deal in Miami, I probably wouldn't spend too much time looking into it. It's just way too risky. We don't know if Miami is going to exist in 2050. So would you like to invest in a place that might disappear entirely? I don't know. But if you go to some of the northern parts, like Jacksonville or Orlando or something like that, there's much less risk. It's a bit more elevated. It's not nearly as sensitive to the storms and everything. And even the heat waves are not as extreme. So I would be very, very comfortable. And in fact, I've made investments in northern Florida. So that's an example of kind of fairly local, but tremendously important variation based on climate change.
Okay. And as someone who's clearly, you are clearly paying attention to this, I love that breakdown that you did. I mean, that sort of comparison that you did within Florida. Do you have a similar comparison for, say, Texas?
Yeah. So in Texas, I think the biggest challenges are going to be in the southern areas on the Gulf, where you have sea level rise issues, you have extreme weather, hurricanes and everything. I haven't studied it nearly as carefully because I don't, for example, have any assets in Houston right now. So that would be an area where I would study carefully before I make investments. I know it's otherwise a popular investment destination, but again, if you go to some of the northern parts of Texas, I would be less worried about climate change in those areas. Because even though climate change is happening, as long as it remains kind of gradual and moderate and everything, a good sponsor will find a way to manage it. Heat waves will make sure that your air conditioning works, and plant some trees and get some, efficient systems and all that. Water, same thing, conserve water, make sure that you've got kind of backup and all that. But if it's a hurricane, or if it's in particular sea level rise, I don't know if there's anything you can do about it. I mean, what would a C-class hurricane-proof property even look like, right? I don't think those exist.
For sure. And, you know, obviously in Texas, there was this winter, we had pipes freezing and electricity out. How do you think about that in terms of attractive markets? Like, is that something that you've thought about since this winter?
Yeah, I certainly am. And in fact, I reached out to some of the sponsors. I do have some, at least I think I have one deal in Northern Texas. So I did reach out and ask if anything happened. My property was fortunately saved. There was no major damage. But I would think about things like, again, how much damage was there? How much did it cost to fix? How much of it was covered by insurance? And critically, next time you have to renew your insurance, what kind of rates are they quoting, right? Because that could really throw you off if they triple the rate because of events like this. And my sense is that many of the good sponsors did fine. They were able to kind of deal with these issues and submit their insurance claims and everything. But 10 years from now, we might see something much more extreme than that. And so far, unfortunately, it seems like the state of Texas hasn't taken the steps to become more resilient, right? A lot of this was kind of what I would even call mismanagement of the power system, kind of complete lack of attention to resilience in that area. And I just hope that they'll do something about it, because policy and regulation is super important when it comes to climate change.
For sure. I think it's quite interesting that so many of them are, well, yeah, that Texas is obviously such a booming real estate market, and yet that could change if the sort of, you know, the systems are not addressed by, you know, the Texas government, et cetera. I'm sure people feel many different ways about that, but great to get your take. So what advice would you have for someone who is, you know, maybe let's just say someone who's thinking about getting into one of these deals, but really not sure because they don't know much about it?
So I would highlight two things. The first one is that it makes sense to study this quite a bit. I didn't study nearly enough before I went into my direct management rental, and it ended up, I think it will end up costing me, you know, quite a bit in not crazy amounts of money, but if I had known what I know now, I would have invested that money much better. So that's one, is just do your study. And when I mean, I don't mean watching YouTube videos of famous, you know, Grant Cardone or something. I mean, like, buy a book on underwriting and read it. That's one thing. The second thing that what I found incredibly helpful is actually connecting with other passive investors. So that's why I love the fact that you're doing this podcast with not the famous people who have $1 billion under management, but also with passive investors. Because for example, I've joined some online forums where people talk about these things. And it's just so great when a deal comes up to hear what other people think about it. What are the challenges they kind of see? What are the risks? Are they planning to invest themselves? Because the sponsor is always obviously trying to sell you something, right? And those were two. Actually, let me throw in one more.
Yeah.
The other thing I've noticed is that once you spend a little bit of time connecting with different sponsors, there is no shortage of deals. So sometimes you get a deal and the sponsor is selling it, hurry up, it's filling up quickly, subscribe now. The reality is that there's going to be another great deal next week. If you have a good pipeline, if you speak to 10 to 15 good sponsors and each of them sends you one good deal a month, that's all you need. So the fear of missing out, it's important to get out of that, because every sponsor will tell you that this is filling out, it's an amazing deal. If you don't join right now, you will miss the opportunity to be rich. And I understand why they do it, but it's not a good way to make investment decisions.
For sure. Yeah, it makes a lot of sense. So what would you recommend as far as, you know, taking your time with deals? Like, would you say, oh, I want to decide on investing with a certain sponsor and then wait for one of their deals to come up? Like, what would you say they should do instead of kind of like getting in that reactionary?
What was very helpful for me was to first talk to a number of sponsors. I didn't make my first like direct investment in a single deal instead of a fund until maybe like 6 or 8 months after I had made the fund investment, which is a lot easier because it's a big fund and they've got like a 40-year record, and you know what you're doing there. So I spoke to a lot of sponsors. I heard them. I asked questions. I took a look at the investment materials, and I just spent some time almost like hypothetically, I joined the webinars even though I wasn't planning to invest, and I tried to get a sense of how this is working. And then at some point, I felt confident enough that now I'm actually going to do it. So I took a look at a few deals and I decided to subscribe to one of them. And by the way, for you sponsors out there, this kind of thought leadership is super important. That's one way I found good sponsors is by finding those who deliver high quality content on like underwriting, finding deals, management, and everything. So that's where you can really often find good sponsors.
Awesome. Well, Johannes, thank you so much for coming on. Your perspective is super valuable. And I know you're a proponent of networking with other passive investors. Give the listeners a way to get in touch with you if you want, and anything else you'd like to share.
Yes, absolutely. So the best way to find me is on LinkedIn. My name is Johannes Urpelainen. Maybe you can share the written version because I don't think anybody's gonna know how to spell that.
Of course.
LinkedIn is the easiest way to get quickly in touch. And I would certainly love to hear from any other passive investors. It really is very valuable to hear what other people are doing and exchange notes.
For sure. Well, I will make sure that your full correctly spelled name is in the show notes so people can connect with you. Thank you so much again, and look forward to hearing from you sometime again in the future and seeing what's going on with you later on. Thanks so much, Johannes.
Thanks for having me. Bye-bye.